Hello everyone, welcome back to our video updates. It's Sade bringing you this week's video regarding what we're observing in the mortgage industry. So normally by April of each year, the listings have gone up. We're just getting over the winter, so there's a lot of activity in the real estate market. But what we're seeing this year in 2020 is that probably because of the uncertainty that's going on around the country, because of the economic dislocation that everybody's experiencing, the mortgage industry is actually slowing down considerably. Looks like listings have gone down instead of going up. They've gone down compared to, say, this time last year by at least 30%. So just in general, as an average around the country in the big cities. I'm in the Austin area, and we are seeing a lot of decline here as well in listings for the homes that are for sale. So really, it's going to still be a seller's market, although the sellers are not listing their properties as actively as in the past. And I think it's probably because everybody's unsure what's going to be happening soon. We're not sure whether the economy would hold up or what the deal would be, and some people are not even sure about their own employment status. I've seen reports that over 24 million people have gotten laid off already in the last few weeks, and that's a staggering amount of people. Although quite a few of people were able to apply for unemployment income, as you know, is just a fraction of most people's normal monthly income. So there's not a lot of cash flowing around as far as families go, as far as small businesses, and even the bigger corporations are feeling the uncertainty as well. So this all is probably to blame for the decline that we're seeing in the real estate market activities. Now, if you're in the market to purchase, just hold off maybe even for a whole year, because we're seeing changes coming from all the different sectors. For instance, the mortgage lenders are also reacting in a different way. They are actually tightening up their requirements for mortgage approval. JP Morgan Chase, one of the largest lenders out there, already changed their requirements this week. And as of this week, the minimum credit score to be able to get approved for a mortgage with JP Morgan Chase is going to be 700, and they're also requiring a 20% down payment, as opposed to in the past where some people were even able to do zero down payment, 0%. So it's going to be a huge change for everyone. Also, Wells Fargo changed its requirements as well, and the minimum credit score to be able to get approved for a Wells Fargo mortgage at this point is going to be 720. Keep that in mind. All the other big banks are doing things right now, and we will hear what their requirements are shortly, but I'm sure they're all going to tighten up those requirements because they can afford to be more picky right now, since everybody's in an uncertain situation. So they can be more picky. They don't want to take on a huge credit risk because of the fact that they can foresee that even for the people that are currently working, there might be a decline in income in the future, or the aftermath of this outbreak might cause people to not be able to meet their mortgage obligations. So the credit lenders, especially the mortgage lenders, they are thinking ahead and thinking, what can we do to protect ourselves as well? Of course, they're going to look out for themselves, right? So that's what I'm hearing. The smaller lenders, like the community banks and the credit unions, they haven't yet caught up to this trend, but I'm pretty sure they will soon. So if you're in the market for a mortgage or to try to do a refinance, you need to do it quickly before all of those requirements change on a mass level, and they will soon. If you're also thinking, okay, well, I can hold off for about 12 months to see how this all plays out, then all you have to worry about is keep an eye on that credit score to see that it stabilizes, it doesn't go down, and to kind of bring it up if you can. And if you're in the situation right now, as many people are not able to make the bills, make payments for the bills right now, then make sure you're making arrangements in the sense that the lack of payments or the delayed payments are not going to show up negatively on your credit report. And if they do, clear that up. You have time to clear that up in the future. But I do think we're going to see the ripple effect of this outbreak going out further than maybe even 2-3 years. I'm seeing some financial institutions saying that they are affected and that they might not recover from the impact for about 3 years. So that's what we are going to look forward to. It doesn't mean you have to stop all your activity, but just know that the options are going to be more limited in terms of being able to purchase, and you're not going to have as many choices. So it is going to be strictly a seller's market, and you may not get the best deal, but at the tail end of it, when some people are forced to sell, that might change relatively soon. If they don't have any other place to turn to other than to sell, to be able to free up some cash, then that might become a buyer's market at that point. I don't know when that would be. So we're looking out maybe about 12 months to see how this all plays out. But I wanted to bring you this quick update. If you have a topic that you would like me to cover, please put a comment below or drop us a note on the website. If you haven't subscribed yet, please hit the subscribe button so that you can get more updates from me. And as always, thank you so much for watching, and I hope you're making the best of this situation that we're all in. And I'll talk to you next time. Next week, I think my update is going to be about the auto industry, auto financing, as well as car leases, and how that is changing during this coronavirus outbreak. So I'll talk to you next time. Take care.